Hey, this is Corey Buljoff, the Real Estate Guy, bringing you this month's monthly market update. I do these so that you can be most informed and educated on what's going on in the housing market with real facts and stats and opinions from experts around the nation. So with no further ado, let's get into it. So I can say what the biggest question I'm being asked today is, are we in another bubble? Is this market going to crash? Is there going to be a wave of foreclosures? What's going on with the forbearance market? So I want to start off with a quote from Mark Hackett, a chief investment of research of Nationwide. When you have a void of information, emotion tends to drive decision making. So what we're seeing right now is people that are maybe misinformed or don't have all the facts. They're making decisions emotionally based on the fact that they think we're coming into another housing crash. When we talk about the housing bubble, there's a couple things that we need to look at. So one thing that we need to look at that actually does validate what's going on and why the question is of, are we coming into a housing bubble, is appreciation. The year over year appreciation has been accelerating month over month this year. So we look at January, we were roughly around 10% nationwide appreciation year over year. And through the last couple of months, we've grown to over 15.4% year over year appreciation. So it makes us, come to the question is 20% too much? Is 25% too much? We know in the housing crash bubble, we were seeing 15 to 25% appreciations each year, and that caused it to come to that bubble. So a validating question, but I can just tell you we're in a much different situation than we were in that 2004 to 2008 crash. So when we talk about housing bubbles, we have to first look at risky loans as they were our main driving force to the housing bubble / crash. So according to Dr. Frank Nothat, a chief economist with CoreLogic, there are marked differences in today's run-up in prices compared to 2005, which was a bubble fueled by risky loans and lenient underwriting. Today, loans with high-risk features are absent and mortgage underwriting is very prudent. So we look at back in 2006, mortgage originations with a credit score of less than 620 was $376 billion in mortgage loans. Whereas compared to today, we're at 74 billion. It's much harder to get a loan today than it was back in 2006, where you can basically say, oh, well, I make this much money. I work for this company. You don't need to verify it all. Just take my word on it. And the bank would give a loan. Today is much harder, as those that are trying to qualify for a loan, they will be looking through. And right now, I will say people can afford a loan that they're getting. We look at Harvard's, the Joint Center of Housing Studies at Harvard University, the State of the Nation's Housing of 2021. These outsized increases have raised concerns that a home price bubble is emerging. However, conditions today are quite different than in the early 2000s, particularly in terms of credit availability. The current climate housing crisis instead reflects a strong demand amid a very tight supply, helped by record low interest rates. Now, when we look at the housing bubble, we have to look at credit availability index. So right now, what we can say is interest rates are at a historical low at 2.8%, where last year we hit a record low, a 40-year record low, 16 different times. So we're in a much better situation with rates and availability. So when we look at credit availability, the higher the number means the easier it is to get a credit loan. The lower the number, the harder. So as you can see, we are nowhere near what we were during 2004 and the 2008 housing crash. And it's actually much harder today to get a credit loan than it was before. So how we look at this chart is the household debt service ratio for mortgages as a percentage of disposable personal income. So after taxes, what is left and what people are spending on mortgage payments. The totally quarterly required mortgage payments divided by total quarterly disposable income. In the 1980s, we were about 4.3%. As we came into the housing bubble crash, we are all the way up to 7.21%. So people were definitely out leveraging themselves and putting themselves in a financial risk of going into foreclosure. Today, we're at 3.45%. So I know it's hard to believe, but we are actually undervalued in a lot of real estate markets across the country as according to affordability. This brings to Mark Fleming, a chief economist with First American. Looking back at the bubble years, housing prices exceeded housing buying power in 2006 nationally. But today, housing buying power is nearly twice as high as the median income price nationally. Many find it hard to believe that housing is actually undervalued in most markets, and the gap between housing buying power and sales prices indicate that there's more room for further house price growth in the months to come. Okay, the way that we read this index is the higher the number, the easier it is to get a loan. What we do know, even about most recently, is that we're nowhere near where the country was as far regard to credit availability. We definitely say is back in the housing crisis, demand was inflated, where today demand is real and people are buying homes that they can afford. They're qualifying for these homes where underwriting is very, very prudent. So we don't see a situation where bubbles fueled by inflated demand by people that can't afford homes. So the more affordable today is something to keep in mind, but in truth, affordability right now is affordability continues to increase in this country. As we can see with NAR starting in January to where we are today. And the moral of the story right now is affordability will become more of a challenge before it gets better. It's based on three components: home prices, interest rates, and wages. The forecasters are saying right now that interest rates are going to go up, housing prices are going to go up, and that'll eat into affordability across the country. But we're going to have to keep that in mind when we're dealing with, are we coming to a bubble? So are we coming to a housing bubble? Absolutely not. This is purely a supply and demand issue. The imbalance of supply and demand we've talked about extensively. So we're going to go back to Sam Cater from Freddie Mac. He says the main driver of the housing shortfall has been the long-term decline in the construction of single-family homes. That's the true statement of why we're in the situation we're in. We are seeing rapid price acceleration and many going way above asking and making people feel that it's just not feasible and feeling like it's like last time. We're seeing rapid price acceleration and many going, gosh, this feels unstable. This feels like last time. And this graphic right here probably is the best graphic to make where we're at. The single family housing of units completed are going all the way back to the 70s. And for which you can see in the past 13 years, we've been below the 50-year average. This means that we literally built more homes in the country back in the 70s to 80s than we have in the last decade. This is causing the issues that we have today. The pandemic comes, homes become so much more important, interest rates drop, and everybody wants to buy. That's the reality of where we've been. And literally, we just don't have enough homes to keep up the population growth and the demand that we've seen and which again has fueled spikes in prices. So as we start looking forward to the rest of the year, we're going to bring you those forecasts of what's going on with the builders, what's going on with houses, and where we can see where we're going to go as interest rates rise, prices continue to rise, and hopefully wages increase as well. So as I said in the beginning, we're going to touch forbearance. This is another thing that the media has gotten on, that we're going to have a huge foreclosure market. Investors are saying we're going to have a foreclosure market. Well, not savvy investors, not ones that actually did their research. Original forbearance. So where we thought we were going to be, the experts predicted and projected that 30% of all homes that were mortgages were going to be in some type of forbearance. Now, what actually happened, the height of the forbearance market, which was May 2020, we are 8.47%, whereas today we're at 3.5%. So if we take that in just numbers, that's about 1.86 million mortgages. Now, to put that in context, so originally, experts said that 30% of all mortgages would go into some type of forbearance program, and all of those would lead to foreclosures. Now, in reality, that number topped at 8.47% of mortgages, and today it's down to 3.5%. And 3.5% equates to about 1.86 million mortgages, which you can see as since May of 2020 to today, we've just nonstop decreased into Now I want to park it here for a moment and talk about what happens when a homeowner exits the forbearance program. And this pie graph shows you that the green and the blue sections, the majority of homeowners exiting the forbearance plan are walking away just fine. They either come current on their current plan payments, or they worked out a payment plan with their lender, such as a loan deferral or modification, something that they didn't have the opportunity in 2008 to do. What we're going to see over time is that blue section is going to continue to get bigger and larger. That's because more people are working out their plans with their lenders and keeping their home. That's a huge difference from where we were in uh, the crash in 2008. Where we may still have an issue is the red section. These are homeowners that are leaving the forbearance plan without a mitigation plan. My heart goes out to any forbearance plan. And my heart goes out to anyone that has experienced this. And if you do go into foreclosure, the good news is, according to Black Knight, is telling us that 87% of homeowners in the forbearance plan have at least 10% of equity. So that means that those homeowners can sell their home, protect their investment, and avoid the foreclosure process. That's huge. In reality, experts are saying the number of homes that could still go into foreclosure is roughly about 200,000 to 300,000. So our hearts again go out to anyone who does end up in that foreclosure process. We never want to see it happen. However, to put that number in context, it's vastly different than where we were last time around. Between 2006 and 2014, about 9.3 million households went through foreclosure, gave up their home to a lender, or had to sell in distress sale. For those homes that do come to the market as foreclosures, they're going to be swooped up right away from investors and maybe even end-use buyers who want to put a little bit of sweat equity and remodel their own home. We're not going to see huge discounts on the market. The data just doesn't support it. So the best thing we can do right now is to let everyone know that even if you do go into foreclosure, put your house on the market, get it sold before the bank can take it from you. So are we going to see a wave of foreclosures? The likelihood of us having a foreclosure crisis is about 0%, according to Ivy Zelman, the founder of Zelman & Associates. So I want to do a couple slides, kind of wrap it up here. But where is the market right now? We're seeing a lot of news articles. The housing boost is officially over. Home sales dropped into a new low. Home sales dropped in June as prices continue to rise. Pending home sales drop. A lot of information in the market is that we're going to see a turn. And we are coming to a turn. Those that are part of my clients know that I've been telling you the market is about to shift. So it's good news for buyers, as there's going to be less buyer demand and more houses on the market. What we can look at when we look at the NAR's buyers traffic report in April 2021, you see right here, a majority of the country was very strong buyer traffic. That's the darker blue color. And strong buyer traffic is the lighter blue color. As we come into May, you're going to see a little bit more lighter blue. And if we go into June, you're going to see it even turn lighter blue. So it has more stable traffic, the strong traffic across the country, but there might not be that sense of urgency that there was back in May and June and previous months beforehand. Some buyers have been discouraged with so many people going over asking price. There's so much money in the economy where we're having end-use buyers paying all cash for things, and it brought a lot of discouraged buyers, and some buyers have actually left the market, which is actually bad timing for them, but great timing for you if you're still in the market, because now you're going to start having more realistic sales prices and more inventory for you to choose from. As you can look at the showing time index starting in January, we've actually risen since January 2020. We had the lull, and then we've again risen above. We're still above the high time of the last 2 years. We've talked about buyer fatigue. We talked about all the things out there. My message to buyers right now is buyer traffic has slowed. So if you're a serious buyer, now is the time to stay in it, to win it. It doesn't mean that there's going to be an opportunity for you just going to walk into and there's not going to be any competition, but there is a chance that you're not going to have 10 other offers to compete against, or maybe an all cash end use buyer to compete with. Given that the sales activities are coming down, we may be sensing a downturn in the market. We're seeing less prevalence of multiple offers, although it's still a seller's market, no doubt. And as you can see, housing appreciation continues to appreciate. We're seeing anywhere from 16.18% year over year. Given that the sales activities are coming down, we may be sensing some turn in the market. We are seeing less prevalence of multiple offers. It is still a seller's market, no doubt. Still a seller's market, but people need to be very cautious about how they price their homes to attract buyers, knowing that these sale activities are declining somewhat. Months of inventory as a home sold, we know anything below 6 months is considered a seller's market, and above 6 months is a buyer's market. We hit the bottom and now we're starting to head back up. At the broad level, home prices are in no danger of decline due to tight inventory conditions, but I do expect prices to appreciate at a slower pace by the end of the year. Ideally, the cost per home would rise roughly in line with income growth, which is likely to happen in 2022 as more listings and new construction becomes available. So again, if you're looking about selling your home, right now might be the height of the market. You might want to get involved in it before you have more competition, have to take less for your home, especially if it's not turnkey. If you're a buyer, even if you've been in the market for some time, know that the light at the end of the tunnel is here, and you're going to start having more choices and less competition with your offers. So I thank you again, Corey Boljoff, the real estate guy. I'm always here to help, never to pressure. If you have any questions, please let me know. I'm here to answer your questions. I cover from San Diego to Santa Barbara, and I'm fueled by your guys' referrals and always a promise to deliver 5-star service. Thank you. Make it a great day.